This video will cover how to complete problem 21-3A. We will not be covering the problem in its entirety. We will only go through 3 and 4. The items for 1 and 2 we've already covered in class today, very similar to problem 21-1B we did for class activity 10. And on that item, just FYI, since it's based on 75% of the factory's overall capacity of 20,000, 20,000 is 100%, so all you'll need to do is multiply 75% times 20,000. That should give you 15,000, and that's what you'll use to figure out the per unit variable cost for each one of these components. And you should be able to follow the requirements for items 1 and 2. So let's begin with item 3. Compute the direct material cost variance, including its price and quantity variances. And then for number 4, we're also going to do that one. Compute the direct labor cost variance, including its rate and efficiency variances. So we'll go ahead and do that. And what we're going to do is use the material labor and variance tool. I have this Excel spreadsheet I included in your Canvas for week 12. And with that, we're going to see our little matrix. So let me make this big so you can see it. We have a space for actual price, actual quantity, standard price, and standard quantity. So we'll need to figure out these factors so that we can plug it into our matrix. First prong is actual quantity times actual price, and we're going to take the difference between actual quantity times multiply standard price. So the difference between these two products, and that will give us our material price variance. And again, the AP and the SP, those two are different, so we're just figuring out the differences in those and the price variance. And then over here, you'll notice that AQ and SQ are different. And here we will figure out the material quantity variance. And finally, we will have our material price variance plus our material quantity variance, and we will determine our total material variance. Keep in mind that if you have a favorable or unfavorable, you'll need to take the net to figure those out. So let's get started. The actual price will be, and let me pull it to the side. We have our company incurred the following actual costs when it operated at 75% capacity. So the direct materials were 91,000 pounds. That was actually purchased. So that'll be our actual quantity. So let's go ahead and plug in 91,000 pounds. And our actual price is $5.10. So I'll plug that in for our AP value. And then we will have our direct labor and our actual hours, and for our direct labor and actual hourly rate, we'll use that when we do our labor variance down here. So I'm looking for my standard quantities for my materials, and if you go top, Antoine Company sets the following standard cost for 1 unit of its product. So that's 6 pounds and $5 per pound. Those are the standard rates. The standard price would be $5. Now the standard quantity, you're going to have to take the 6 pounds and multiply it by the number of units that were actually made for the period of time. Put it back in there, $5. And for our standard quantity, we are at 75% capacity. And again, I was telling you earlier that that's 15,000. Because 75% of 20,000 is 15,000 units, and we are going to figure out the standard for that. And if you take your standard pounds of 6 pounds. You'll multiply that by 6. So that's 15,000 units times 6 pounds. So our standard quantity will be 90,000. So we just took the 15,000 times the 6 pounds. So we plugged in our values, and if you multiply your AP times your AQ, you will get the 464,100. That's our first prong. And then we will get our actual quantity of 91,000 pounds. Multiply that by our standard price, which is $5. That'll be $45,000. Take the difference between these two amounts, and you will see that we get an unfavorable variance indicated by the parentheses, but keep in mind that what we actually spent was more than what we were expecting to spend. See that $5.10 is a little higher than what we anticipated. So as a result, since these are dealing with expenses, are also known as costs, we're experiencing an unfavorable material price variance. And if we look over here, you'll see that, let me make this bigger. You'll see that we have our standard quantity times standard price, so the $5 times the 90,000, and we will take the difference between these two products. And again, the actual quantity was more than our standard quantity, what we were anticipating. So as a result, we're using more product. So like if we were using the 3 tires instead of 2 tires to make a bicycle, that's not good. We're using too much. So the material quantity variance is actually unfavorable as well, and that is an unfavorable variance of 5,000. So now that we have 2 unfavorable variances, if we add these 2 together, we will get the total material variance. And you'll also notice that if you take the difference between these 2 products, you will get your total material variance, 14,100 unfavorable. And that's all you need to do for part 3. And let's go to labor variance. Now the labor variance, very, very similar to the material variance, except for that instead of having a price, we're going to have a rate, because we're talking about paying people a per hour rate for our direct labor. And then instead of having our quantity, we're going to have our hours, since direct labor is based on how much time a person has actually worked. So this AR is the same as the AP for quantity, for materials. This AH is the same as AQ for quantity for the materials. And then we have our standard rate and our standard hours. And again, as I was showing you in class, I showed you that AA and then AS and then how do you know which one to use? Well, this is dealing with the rate variance. So you'll see that the AR and the SR are the ones that change. So the second one would be AR and the second one SR. And down here, we're calculating the rate variance. It's just a difference between those 2 products. So let's go ahead, plug everything in, and see what we get. So we're going to go back to the problem, page 963, for our direct labor standard. So 2 hours is what we expect, and it's $17 per hour. So that's our standard rate, $17. And our standard hours, again, we're going to use the 15,000, because that's at 75% capacity. Multiply that by the 2 hours per unit, and we get 30,000 for our standard hours. Now our actual rate will be $17.25. We'll pull that from what was actually incurred. So $17.25. And then our actual hours was 30,500. 30,500 hours. And you'll see here, all we did was multiply our actual hours times our actual rate. We get a total here. And our actual hours times our standard rate, we get a total here. And again, because the actual rate is more than our standard rate, that's going to be an unfavorable labor variance. And then we'll go and do our calculation for our standard times standard. So our standard hours times standard rate, we get for the 510, and the difference between the middle prong and the end prong, because the actual hours ends up being more than the standard hours, we have an unfavorable variance here as well. And then you just add those two up together, and this is what it looks like. Now, if this is too difficult for you to try to remember this matrix, it's just too confusing, you can also use from the reading. You can actually plug it in and use these three formulas to figure them out in terms of the variances for material variance and labor variance. So that concludes this video. The other parts you should be able to do based on what we covered today in class. Any questions, post in Google Hangout.